Ghana is a country that faces high inflation, which means that the prices of goods and services keep rising over time. High inflation reduces the purchasing power of money and makes it harder for people to afford their basic needs. To control inflation, Ghana's central bank uses a tool called the policy rate, which is the interest rate at which it lends money to commercial banks. The policy rate influences other interest rates in the economy, such as the rates on loans, deposits, and bonds. The central bank has set a high policy rate of 29.5%, which is one of the highest in the world. This means that borrowing money is very expensive and saving money is very rewarding. By doing this, the central bank aims to reduce inflation by discouraging borrowing and increasing saving. How does this work? When borrowing is expensive, people and businesses tend to borrow less and spend less. This reduces the demand for goods and services, which lowers their prices. When saving is rewarding, people and businesses tend to save more and invest more. This increases the supply of goods and services, which also lowers their prices. By balancing the demand and supply of goods and services, the high policy rate helps to bring down inflation. The high policy rate also affects the exchange rate of Ghana's currency, the cedi. When saving is rewarding, more people want to hold cedis and earn interest on them. This increases the demand for cedis and makes them stronger against other currencies. A stronger cedi means that imported goods become cheaper, which also lowers inflation. The high policy rate has helped Ghana to reduce its inflation from a peak of 54.1% in December 2022 to 41.2% in April. The central bank expects the downward trend in inflation to continue as it maintains its tight monetary policy and relative exchange rate stability. However, the high policy rate also has some drawbacks, such as slowing down economic growth, increasing debt servicing costs, and crowding out private sector investment. The central bank has to weigh these costs and benefits carefully and adjust its policy rate according to changing economic conditions.